Hello, thank you for joining us for the results presentation in respect of our year ended 31 March 2022. In terms of highlights for the year, assets under management increased by 6% from 20.9 billion to 22.1 billion, with average AUM increasing by 37%. There has been continued strategic progress with the launch of an established sustainable thematic equity team that will provide an additional £9 billion of sustainable equity capacity in Article 9 funds. The emerging market stars funds have attracted further inflows, with assets under management approaching £1.2 billion, despite current year market sell-off, and we continue to take market share for these funds. There were net inflows in the year of £390 million, although net flows in the final quarter were negative. Client channel diversification improved, with £745 million net funding into segregated institutional mandates, which brings total segregated AUM to in excess of £1.2 billion. Our strong balance sheet and improved core operating profit enables the second interim dividend to increase to 32p and total dividend to increase by 15% to 46p. There have been encouraging flows and performance for a number of Polar's strategies. Product diversification has improved, with technology now representing less than 40% of AUM, down from above 50% a year ago. Our fund performance relative to peers remains compelling, with 84% of assets under management in the UCITS fund range ranked in the top 2 quartiles against peers in the Lipper universe over 3 years. There has also been continued focus on core operating profit, with an increase of 35% in the year.
As interest rates have risen to combat inflation, growth sectors and growth markets have seen the biggest falls, with the technology sector and the US equity market reversing their gains from the last couple of years as valuations in equity markets have compressed. Interestingly, the major market least affected by the sell-off in 2022 has been the UK, whose large listed oil and mining stocks have declined by much less than other sectors. These companies have in the past performed well in periods of high inflation, and this time, of course, the oil price has risen sharply due to the Russia-Ukraine conflict. This chart summarises the performance of Polar strategies with a track record exceeding 1 year, and the bars on the chart show annualised fund performance since inception, while the colours capture performance versus peers using Lipper quartile rankings. And dark blue is first quartile, light blue is second quartile versus peers. And the message here is one of consistency of performance across Polar's range of strategies, with the vast majority of Polar's strategies and assets under management ahead of benchmark since inception. All the strategies shown here are in the first or second quartile versus peers, with top quartile peer rankings for established strategies such as global tech, healthcare opportunities and biotech, and for more recent launches such as emerging market stars and healthcare discovery. This slide expands a little on capacity management. Our aim is to set appropriate capacity limits for all Polar strategies so that we prioritise fund performance. And capacity is reviewed as part of the investment oversight process using a variety of observations, including trading liquidity, which is days to liquidate under various participation scenarios, client concentration, and client servicing requirements. And there is significant remaining capacity, roughly 40 billion sterling, thanks to strategies launched in the last few years. And we're always looking for differentiated strategies to add capacity for the future. We do set the bar pretty high in terms of the investment credentials and commercial appeal of potential new teams, but the door is always open to discussions with interesting investment teams.
The European funds industry posted a near record year in 2021 in terms of flows, surpassing €430 billion, and in the US, fund flows topped prior records. Under the pressure of a growing array of headwinds, uncertainty, and market volatility, investor resilience finally buckled this year. In Europe, the funds industry has seen net outflows of €70 billion to the end of April, of which €15 billion was accounted for by equity outflows. Q1 2022 was the first negative quarter for equity fund flows since the pandemic outbreak in March 2020. In the US, fund flows turned negative in April for the first time since March 2020, with mutual funds and ETFs registering combined outflows of nearly $90 billion over the month. The rotation in markets and subsequent sell-off has seen investors seek safety in more defensive asset classes at the expense of higher growth sectors such as technology that performed well through the pandemic. On the 31st of March 2022, our assets under management stood at £22.1 billion, an increase of 6% over the financial year. We recorded net inflows of £391 million in the reporting period, or 31% of the total asset growth, the balance attributable to global market and investment performance. Assets under management have grown at a compound annual growth rate of 19% over the past 5 years. The average assets under management for the year were £22.8 billion compared to £16.7 billion the previous year. The financial year began as the prior year had ended. We recorded 3 consecutive quarters of positive net inflows before investors moved to a risk-off stance, leading to a negative final quarter, the first since Q1 2020. Over the financial year, more than half of our strategies recorded net inflows, led by emerging market stars, healthcare, financials and global convertibles. The rotation witnessed in markets saw renewed interest in the financial sector, driving £277 million in new share issuance by the Polar Capital Global Financials Trust. Conversely, our technology funds dominated outflows, reaching £1.3 billion, though this figure compares to net inflows of £1.8 billion into the same funds over the previous comparable period. A number of our strategies have had positive net inflows subsequent to year-end, including global insurance, healthcare, blue chip and global absolute return, and the rate of net outflow from the technology funds appears to have slowed. As noted previously, total inflows for the financial year were £391 million. If we exclude our technology funds, net inflows over the same period across our other strategies totaled £1.7 billion. As you can see in the chart of cumulative net flows, the outflows from technology began in October 2021, coinciding with interest rate hikes and the start of the sell-off in the technology sector as investors rotated from growth to value strategies. It's worth highlighting that while we have seen many technology investors reduce their weighting to the sector on valuation concerns, few have redeemed their entire holding from our funds. Q1 2022 was Polar Capital's first negative quarter for fund flows since the first quarter of 2020. As investors moved to a risk-off stance, we saw net outflows across a number of strategies, dominated by technology. However, as you can see in the chart on the right-hand side, 7 of our strategies had net inflows over the same period. Emerging market stars maintained good flow momentum, which has continued post-year-end. The Polar Capital Global Financials Trust continued to trade at a premium, enabling further new share issuance, and on the back of strong performance, our Global Insurance Fund also saw net inflows, which have continued post-year-end. Following their launch last November, our Smart Energy and Mobility funds had good flow momentum in Q1 2022, and both have a promising new business pipeline.
Over the next few slides, we look at our financial results, the strength of our balance sheet, and the capital position of the overall group. First, the key highlights. Underlying the results is a 37% increase in our average AUM over the year to £22.8 billion. This higher AUM base in turn allowed for the 31% increase in our net management fee revenues to £187.3 million. Our net management fee yield over the year measured 82 basis points compared to 85 basis points in the prior year. The decrease is a result of a changing product mix due to a rebalancing of the technology strategy and the rest of the business, as well as an increase in institutional segregated mandates. Our longer-term guidance on fee margins reducing by at least 1 to 2 basis points each year still holds. Looking at the key components of our profitability, this year has really been a case of expansion in our core operating profits, but a reduction in performance fee profits and other income. The higher average AUM base meant core operating profits improved by 35% to £69.4 million, resulting in a core operating margin of 37%. However, the more challenging market environment meant performance fee profits this year of £4.1 million were much lower than last year's above average £19.5 million. Other income represents the profits and losses recognised on our seed portfolio, and the more muted fund performance meant that we recorded mark-to-market losses this year. Tying everything together,
profits before tax amounted to 62.1 million, which are down 18% on the prior year, and this translates into an adjusted diluted total EPS of 56p, which is a 10% decrease. Our dividend policy and confidence in the business, though, has enabled the board to declare a second interim of 32p and a total dividend for the year of 46p, which is a 15% increase from last year. Next, we look at the cost profile of the business. Total operating costs for the year were 140.9 million, which is a 19% increase on the prior year. As the chart on the right illustrates, this increase is driven partly by higher staff compensation costs, with the arrival of the Sustainable Thematic Equity team during the second half of the year, as well as the cost of the Phaetian and Dalton teams being included for a full 12 months compared to the prior year. The remaining increase in total costs is attributed to higher acquisition-related exceptional items from both the Dalton and Phaetian transactions. These exceptional costs are either non-recurring or non-cash, and therefore excluded in determining adjusted diluted EPS. A further 3.1 million of termination and reorganisation costs related to Dalton were recorded this year, along with an additional charge of 1 million relating to deferred consideration payable. The annual amortisation of intangibles amounted to a further 1.9 million. Following the closure of the Phaetian mutual funds in May 2022, the related intangible asset and deferred liability were derecognised at the year-end, and further reorganisation costs were recorded, resulting in a net impact to profit before tax of 1.6 million. The closure of the Phaetian funds is immaterial to the ongoing core operating profits of the business. The capital position for the group remains strong. The bar chart on the left shows how allocation of capital across seed investments, regulatory capital, and general working capital remains broadly consistent with the prior year. The overall surplus capital of around 70 million over regulatory requirements remains a healthy one. And finally, the framework applied for the use of capital remains unchanged as we look to balance returns to shareholders with strengthening and growing the business. Our balance sheet and surplus capital is used for four main activities: to seed new product ideas and teams and therefore serve as the R&D function of the business, to maintain a strong balance sheet for future growth and to act as a buffer for regulatory requirements and against market shocks, to return capital to shareholders through our annual dividends, to minimise the dilutive impact of group share incentive schemes through our ongoing share buyback programme. On the final slide of the finance section is a reminder of our dividend policy. In line with our stated policy, which remains unchanged, we have announced a second interim dividend of 32p and therefore a total dividend for the year of 46p. This represents a 15% increase on last year's total dividend and reflects an 82% payout ratio on adjusted diluted total EPS. And so, to summarise, despite the extremely challenging economic environment before us, we are quietly confident that we can navigate the industry-wide pressures on AUM and revenues, and that combined with prudently managing our cost base, we can continue returning capital to shareholders through our dividends, whilst at the same time investing in the future growth of the business.
Turning to strategy now, our stated objective has been growth with diversification. In terms of product diversification, we've made good progress with 3 of our largest 6 strategies in terms of AUM having been launched or acquired in the last 5 years, with the largest percentage growth in the year on opening AUM recorded for the emerging markets STARS strategies. Following investment into systems and migration of middle office operating platform undertaken in 2018 to 2020, segregated accounts for institutional investors can be efficiently managed and serviced. Assets under management in SMAs make up 5% of total AUM and will grow over time. The investment in our Nordic distribution over the past 3 years is yielding positive results, and Asian distribution has improved with a Singapore presence currently under consideration. Ahead of Asia is focused on Northern Asia and Southeast Asia, where we have successfully funded an Australian and Singaporean institutional mandate. Another area of progress for the business has been sustainability and social responsibility. More than half of our 25 funds are now Article 8 and 9 funds as defined by the SFDR. Polar is now a signatory to the new UK Stewardship Code, and we continue to measure our carbon footprint and remain focused on reducing our footprint in support of the Paris Agreement. Polar commits up to 1% of core profit to making a positive impact through societal and environmental initiatives, with 15 charities supported in the last year alone. The Polar Capital Aspire scheme, PCAS, that funds laptops and bursaries for 4 students from the Westminster City School has progressed and is having a noticeable positive impact on the school and its students. Growth with diversification remains our core strategy, and we are seeing results. We are continually searching for highly active, differentiated strategies with compelling track records. Additional teams can either be procured through lift-out or acquisition with full integration. Regional distribution diversification remains a priority, and there is significant remaining capacity to fulfill this objective. Turning to summary and outlook, we have a strong balance sheet, and our cash generation supports investment in new teams, seeding funds, share buybacks and dividends. Teams and strategies launched in the last 5 years make up 3 of the largest 6 teams in terms of AUM, and flow momentum continues into the emerging market stars funds. There is early support for the sustainable thematic funds, Smart Energy and Smart Mobility, which were launched in Q4 of 2021. Continued focus on growing core earnings to support a growing dividend remains in place, and conversations with potential new complementary teams with compatible culture continue at pace. Significant capacity across highly active funds provides a platform for growth across more diversified distribution channels and regions. Thank you for watching the presentation.